Here is a question worth asking this morning. Why is the world's reserve currency looking fragile on the very day its central bank takes center stage? It is Wednesday, July 29, 2026, and the British pound is quietly gaining ground on the US dollar. Pound sterling to US dollar has edged higher in European trade after spending the previous session going almost nowhere, and that flat day matters, because it tells you traders were sitting on their hands, unwilling to commit before the Federal Reserve speaks. Today they have started to commit, and the direction of travel is against the dollar. This is not a dramatic collapse. It is a steady, deliberate drift lower in the greenback, the kind that happens when the market has already decided how a central bank meeting is likely to land and is positioning early rather than waiting for confirmation. So what is actually pressuring the dollar? Currencies are priced on expectations, not on today's facts. When markets believe US interest rates are heading lower, the yield advantage that makes holding dollars attractive begins to shrink, and money moves elsewhere. That is the core mechanism behind this week's softness. Add uncertainty about the Fed's own message, and you get a currency that struggles to attract buyers even in normally supportive conditions. Notice the breadth of it. The dollar is not just slipping against sterling. The euro has advanced ahead of the policy decision, and the Indonesian Rupiah has strengthened as Fed uncertainty weighs on the greenback. When a currency weakens against a developed market major and an emerging market currency on the same morning, that is a dollar story, not a pound story or a rupiah story. The Federal Reserve announcement lands later today, with the statement followed by the chair's press conference, which for UK viewers falls in the evening. Here is the part most people get wrong: the rate number itself is usually the least important thing in the release. Markets have typically priced the decision days in advance. What they cannot price is the language. The wording on inflation, the description of the labor market, the hints about the pace of any future moves, and above all the tone in the press conference. That is where volatility comes from. A decision that matches expectations but arrives with a more cautious message can strengthen the dollar within minutes. A decision that matches expectations but comes with softer language can extend today's slide. So watch the words, not the headline figure. Step back a day and you see how quickly this shifts. On Tuesday, July 28, 2026, the mood was different. The Canadian dollar advanced as easing risk aversion actually lifted the US dollar, a reminder that safe haven demand and rate expectations can pull in opposite directions on the same session. 24 hours later, Fed nerves have taken over again. There is a longer-term thread here too. Capital Economics has argued that if the artificial intelligence investment boom unwinds, the Korean won could appreciate by around 15% within 18 months. That matters for sterling holders because so much of the dollar's recent strength has rested on American technology and AI capital inflows. If that engine slows, the dollar loses a support pillar that has nothing to do with interest rates at all. Sterling never moves on American news alone. The pound's path depends just as much on what the Bank of England does next, because exchange rates track the gap between two sets of interest rates, not one. Once the Fed is out of the way, attention swings straight back to Threadneedle Street. If the Bank of England is seen as slower to cut than the Fed, that widening gap favors the pound and helps explain the resilience we are seeing today. If UK inflation data or wage growth surprises to the downside before the next meeting, that support can evaporate quickly. UK politics adds another layer. Domestic events, including by-elections and fiscal announcements, have repeatedly nudged sterling this year, and currency traders now treat the UK political calendar as a genuine market input rather than background noise. Now the practical part. A stronger pound against the dollar has immediate, measurable effects. If you are booking a holiday priced in dollars, or buying anything from a US retailer, today's move works in your favor, and travel money providers usually pass on a firmer rate within a day or so. UK importers who pay for goods in dollars, which includes energy, commodities, electronics, and a great deal of raw material, see their costs fall. That eventually feeds into shop prices, though the lag is typically months rather than weeks. The flip side is exporters. A firmer pound makes British goods more expensive for American buyers, squeezing margins for manufacturers and services firms who sell across the Atlantic. Same currency move, opposite outcomes, depending entirely on which side of the trade you sit. There is a portfolio effect too, and UK investors often overlook it. Roughly 3/4 of FTSE 100 revenues are earned overseas, with a large slice in dollars. When sterling strengthens, those foreign earnings translate into fewer pounds, which acts as a headwind for the index even if the underlying businesses are performing perfectly well. That is why the FTSE 100 sometimes drifts on days when the pound rallies. If you hold a US tracker fund or American shares without currency hedging, a stronger pound reduces your returns in sterling terms, quietly and without any change in the share prices themselves. This is exactly the kind of exposure worth understanding before a major central bank event, rather than discovering it afterwards on your valuation statement. Where does this go from here? In the near term, expect the calm to break. The hours around the Fed statement and press conference are usually the most volatile of the month for pound sterling to US dollar, and moves in both directions within the same session are common as the market digests the language. Beyond tonight, 3 things will decide sterling's direction. First, whether the Fed signals a faster or slower easing path than markets currently assume. Second, the next round of UK inflation and labour market data, which shapes Bank of England expectations. Third, global risk appetite, because the dollar still attracts safe haven flows whenever markets turn nervous, as Tuesday demonstrated. If US rate cut expectations firm up while the Bank of England holds a steadier line, the pound's advantage persists. If not, today's gains can be given back quickly. The takeaway for Wednesday, July 29, 2026 is straightforward. The pound is not surging on British strength. It is rising because the dollar is soft ahead of a Federal Reserve decision that traders are positioning for in advance, and the same weakness is showing up against the euro and the rupiah at the same time. That distinction matters, because dollar-driven moves tend to reverse faster than moves built on genuine domestic momentum. If you have a currency transfer, a holiday budget or an unhedged US investment, today is worth paying attention to. Do not chase the move in the minutes after the announcement, when spreads widen and prices whipsaw. Wait for the dust to settle, then act on the level, not the headline.